The question I get asked more than any other is, how can I best protect my portfolio in the event of a crash? The general feeling seems to be one of unease, and it's not hard to see why.
How about this for a prediction? A market crash coming in the third quarter of this year, and the U.S. is headed for bankruptcy?
Mark Phelps says another financial crisis could hit global markets in the second half of the year, and it could be even worse than the one we experienced 6 years ago.
What you're looking at would be a complete bludgeoning of stocks, everything else.
Yes, because of course, everything is drastically overpriced.
We are already in or rapidly heading into a recession. Corporate earnings are already falling. Stocks are way overvalued and companies are way over leveraged. So there really is nothing to support this market.
At least as bad a bear market as 07 to 09, at the very least. And that was more than 50%.
Yeah, that cut us in half.
You say that a huge sell-off is coming, the biggest in my lifetime.
Greetings, people of the world. There is overwhelming evidence that the next stock market crash could strike any day now.
Market crash any day now. Any day now.
People are worried. They're desperate for advice on how they can protect their portfolio without sacrificing gains. Unfortunately, much of the advice you've heard is bad. And in this video, I'll tell you exactly why that is. Then I'll take you step by step through 5 practical, actionable strategies that you can implement or start learning more about today. Oh, and by the way, for this video to be relevant and useful for you, you don't have to think there's going to be a crash tomorrow or that one is even on the horizon. If you think there is a non-0% chance that a crash could happen, then surely it's in your best interest to seek out the best ways to protect your portfolio. Okay, now we're ready. Now, if this is your first time here, my name is Steven Spicer, and I am committed to helping you build a rapidly growing, highly diversified net worth, one video at a time. And part of that is finding the best ways to protect and grow your hard-earned assets. Now, if that's something you're interested in, take a moment right now, hit that subscribe button, hit the bell so that you're notified every time we create a new resource that can help you on your journey. Over this last year, I've been asked about this video's topic more than anything else. Steven, what can I do to protect my portfolio? What stocks should I invest in to prepare for a crash? Where should I have my money to be best protected, but also not entirely miss out on any growth that happens before a crash? Now, that doesn't mean that all the people asking these questions are doomsayers. It just means they're all smart. You should always, whether or not you believe a crash is imminent, you should always want to protect your portfolio as best as possible, especially if you can do it without sacrificing growth. In fact, asking myself this question forever changed the course of my career. In a past life, I worked under the umbrella of a large financial planning company. I was required to recommend cookie-cutter investment solutions for my clients. The same solutions parroted by almost every financial advisor and guru today. And we'll see in just a second why those solutions don't work. Meanwhile, I had lost a significant amount of money in the crash of 2008 and had begun to dedicate my personal time to solving this problem, finding a way to avoid losing so much of my money in a crash, but without sacrificing growth. After finally feeling confident with my own strategy and experiencing success in the market, I realized I would not be allowed to recommend these solutions to my clients. They didn't fit neatly into the industry's prescribed model. So yeah, this video is going to be longer. My business exists because I ask this question. So I've got some things to say. I think a lot of the general advice that's out there is lacking. You've probably heard 2 extremes. One side says that you should move your assets into cash to prepare for the coming crash. And the other side says that you should pretty much ignore the dangers of an imminent crash because you're hopeless to try and time it exactly. So it's best to just strap in and stay in the market, no matter what. At first, both these strategies seem to be rational. Let's briefly explore the move to cash strategy. All right, well, we can make this real simple. Here's a little squiggly. That's a technical term for what you might expect a market cycle to look like. And here's the market peak, the point when its value is the highest before falling during a crash. And here's the market's trough, the lowest point in the cycle just before recovery. Now, the first general strategy, the one where you move to cash, in that strategy, those experts would recommend that you move a little to cash, maybe right here, and then maybe a little bit more right here. And I guess ideally you are 100% in cash right here, right around the peak. And then the market crashes, just as you expected. Congratulations, your cash is performing much better than stocks right now. Now, according to this simple strategy, you would then start to re-enter the market with a little bit of your money, maybe right about here, and then with a little bit more, let's say right about here, and then a little bit more here, and of course, just before full recovery, maybe let's say a little bit after, when you feel confident and you invest 100% of your money back into stocks. Back into stocks that have seemingly been in free fall for the last however long. But it's easy, right? You see, it's a super simple strategy. The problem is, in practice, that doesn't work. Sure, you could get totally lucky and it could play out just like that in theory. But in practice, that's not how it happens for most people. To best understand this, you need to mentally put yourself in that situation. On the way up, as the market is starting to become overvalued, when you're supposed to be gradually shifting into cash, when exactly do you start? And with how much? Pull out too much too soon and you could miss out on a lot of gains. Or worse, you could pull out of the market, watch it continue to rise for another 2 or 3 years as your associates laugh at you and get rich, and then decide to get back in after questioning and doubting yourself. And if you think that can't happen to you, that's actually the exact way that the way more intelligent than all of us, Sir Isaac Newton, lost his entire life savings. But that's a story for another time. The point is, if it could happen to him, it could happen to you. Also consider the famously successful investors who were prophesying that the NASDAQ was overvalued in 1997, some earlier. After hearing their warnings with their sound logic and data, could you have patiently sat on the sidelines as your friends' portfolios tripled over the following 3 years? It's not that they were wrong about the market being overvalued. It's just a fool's errand to try to time it. And then on the other side of the equation, when markets crash, they usually do so pretty fast and hard, meaning most of the losses happen over just a few, not necessarily consecutive days. And that's the part that is truly terrifying about crashes. It can feel like the world is coming to an end.
Everybody panic!
Yeah, this strategy makes sense on paper or on a whiteboard, but psychologically, in the moment, most people freeze. It's hard to put your money into something that just keeps going down. This is why when you look at statistics on money moving in and out of the market, more money moves in at the peak and more money moves out at the trough. It's not that people are dumb and don't realize that that is not ideal. It's just a psychologically impossible proposition for most people. So sure, in theory, this strategy sounds great. It sounds really simple and logical, but in practice, it's clearly not. And we could spend an entire video diving into additional examples, logic, data, facts as to why this is not practical or actionable advice. And if you're interested in that or have some additional questions, be sure to let me know in the comments so that I can help. But let's keep moving. We've got a lot of ground to cover. The other contingent would recommend you just ignore the possibility of a crash. They use many of the arguments I just made to show why the move to cash strategy doesn't work. They talk about how crazy it is to try and time the market. They are particularly fond of cliches, like time in the market is better than timing the market. And again, their strategy makes sense on paper. Let's go back to the drawing board real quick. So once again, we have this familiar squiggly. Now, in this strategy, you just put your money in the market whenever you have it, regardless of whether or not the market seems over or undervalued to you. So you might put some in right here, you might put some in right here, and of course, you might even put some in right here. The point that proponents of this strategy are trying to make is that it doesn't matter long term. Even if the market crashes right here, the moment after your last investment, over the long run, they argue that the market always goes up. That if you're patient and stay the course, eventually you will make all of this money that you lost back and more. So here we've got to have a winner. That's a super easy strategy, right? Once again, in practice, you'll find that it doesn't play out like that for most people. These aren't new ideas. People were throwing around the same advice pre-dot-com crash, pre-Great Recession. So we can see how this played out for the majority of people in the market at those times. There are a lot of examples I could pull from here to prove this point, but probably the easiest and most profound is from the financial services market research firm Dalbar. Every year, they compare stock market returns for the average investor with the returns of the stock market itself, using the S&P 500 as a benchmark. Over the 30-year period ending in 2016, the S&P 500 averaged a 10.16% annual return. The average equity or stock investor, however, averaged 3.98%. By the way, if someone tells you to expect an 8, 9, or 10% return from the market, they're basing that number on the market's past return, not what actual human beings have historically made. And that makes a big difference for you long term. That's the difference between $1,000 growing to only $3,000 instead of $18,000 over 30 years. And you might think this is an argument for staying the course, but this significant difference is a result of human psychology, our emotions. If you don't allow yourself to even mentally prepare for the possibility of a crash, when it does happen, if it happens, you could be ruined. When you watch your portfolio fall by 20% in a single week, those cute cliches don't matter. This is your life savings. Likely if it drops below a certain point, it may not recover fast enough for you to be able to retire or hit some other important goal. And sure, maybe the people giving this advice can follow it. Maybe you, watching this video, have exceptional discipline and would stay in the market the entire time, even if it's depressed for 25, 30, or 40 years, whatever. I don't know if that's necessarily the right thing to do, but maybe you can. Maybe the people giving this advice can. But the fact is, the average person, the person they're speaking to, historically, statistically, will not. And that's why this advice is dangerous. So the advice is almost impossible to follow. But when you're invested like they tell you, it's also not always the right thing to do. Let's consider some numbers. After the 1929 crash, it took 25 years and a world war to pull the US markets back to new highs. That's a long time. Not to mention that a world war is a pretty rare catalyst. So depending on where you are in your investment life, that could be disastrous. And is it possible for the market to remain depressed for even longer? Sure it is. In 1989, Japan's market was all the rage, but people who followed this advice and were actually able to mentally tough it out and stay the course, they were ruined. Here we are, almost 30 years later, and their market is still only around half its former high. Here's the problem with their logic. The proponents of this strategy are using the last 100 to 150 years worth of data, which only includes 10 to 15 actual crashes and or sell-offs. They're using that data to prove their point. But what if that isn't enough to predict outcomes forever into the future? I get pretty heated when I think about it, because I feel like a lot of people who are offering investment advice or presenting themselves as investment experts don't ever critically think about this. They just regurgitate that same rhetoric as everyone else. And I'm not saying that I know the market is going to crash. I'm not predicting a Japan-like scenario. I'm just not willing to ignore the possibility that history could be made, records could be broken. But the point of this video is not to leave you hanging. It's to give you some practical, actionable advice. What you can do instead to better protect yourself in the event of a potential crash, and still allow your portfolio to grow in the meantime. I'm going to give you 5 very specific steps that you can take. I've put them in order of simplest to understand and implement to more advanced. The strategies that might require a little more money and definitely will require additional time and understanding. Obviously, none of what I'm about to say is meant as a direct recommendation from me to you specifically. As with all of this, I don't know you. You should do your own research and consult financial professionals who are intimately familiar with you and your particular scenario. And again, with each of these, I'm going to cover them briefly. This is a long video. It's already a lot to process in one sitting. So be prepared to let me know in the comments which of these following subjects you'd like to explore further. Now, just so you know, I'm actually taking you somewhere. I want to show you something personal and relevant, and it'll come up in strategy number 4. But on the way, I'll take you through the first 3. Strategy number 1, shift some of your portfolio into dividend stocks. Now, I know some of you already have dividend stocks in your portfolio, and that's great. You should take comfort in knowing that dividend stocks perform better during crashes. As long as the company is healthy and thus will be more likely to be able to continue paying their dividend, they're looked upon as a sort of safe haven. Ooh, shortcut. That's why when I seek and present to you interesting dividend stocks like I did in this video and will each month going forward, I'm looking for the healthiest companies that pay high and consistent dividends. During crashes, investors view healthy dividends as additional downside protection. As such, you'll see a lot of scared growth stock investors shift into these dividend payers. This helps the stock of these companies not fall quite as fast as the rest of the market, so you can insulate your portfolio a little. And if the market doesn't crash, honestly, a lot of years the dividends paid make up most or even all of the S&P 500 returns. So by shifting to healthy dividend-paying companies, you're still able to capitalize on some market returns while also protecting your portfolio a little from major downswings. You'd also be more likely to stay the course, as your fall should not be quite so dramatic. And even if the ride back up is long and drawn out, like decades, you still have an income source from the dividends. Strategy number 2, always invest with a margin of safety. This strategy is near and dear to my heart. It's what helps me sleep at night. You should always invest with risk and reward in mind. And it sounds obvious, but people don't do it. The side of the investment equation everyone looks at is the potential upside. How much could this go up? That's fine, that's great, but that's just one side of the equation. And I'd argue that for your long-term success, it's the less important side. You should also consider how much the stock could go down if you're wrong.
You lost everything.
You suck. Or if a crash happens, or if something you don't expect happens. Is there any downside protection? Like, do they already have solid earnings that will likely always drive some sort of market value no matter what happens? If so, how much per share? What's the value per share of their net assets? Is it positive? Do they pay a reasonably maintainable dividend? These are considerations that can offer a sort of downside protection for a stock, making it less likely that this stock could fall below a specific price. This is your margin of safety. No matter the value of the market overall, I always seek stocks with this profile. Significant asymmetric upside potential, where I've assessed its fair value to be 100% or more than the market value. Limited downside risk, that's the margin of safety we're talking about, and some sort of identifiable and reasonable catalyst, something that might wake the market up to its true value. This is the foundation of all my top stock pick videos, and I'll link to the playlist so that you can get some specific examples of exactly what I'm talking about here. And if you'd like more than just one of these well-researched ideas each month, check out spicercapital.com/insider. There you can access all of our research and even my specific trades. Side note, when you adopt this profile, as long as you never lower your standards, you will naturally find less opportunities in overvalued markets, which means you'll naturally have more in cash, just like that move to cash strategy would suggest, but without ever really having to worry about it. And if and when the market does crash, you have that downside protection for each individual stock in your portfolio. A suit in a humid 95 degrees, not a good strategy. Strategy number 3, diversify, but not like you think. I don't just mean bonds. When most people consider diversifying their portfolio beyond just stocks, they think, how much should I put into bonds? And that's it. That's the extent of their diversification. They have 80% stocks and 20% bonds, or 70-30 or 60-40, and they feel safe. They feel like they're as diversified as they can be. And I get it. It's pretty much all that's ever really talked about in the industry. But as traditional assets like stocks and bonds are becoming increasingly correlated, it'd be prudent to seek additional uncorrelated asset categories. After all, if all your assets are correlated, that means when they crash, they're more likely to all crash together, which kind of defeats the purpose of diversification, right? Luckily, stocks and bonds aren't the only options anymore. These days, there are other strategies that are less correlated than those traditional vehicles. I'm referring to the group of strategies that is broadly classified as alternative investments. Historically and logically, with several of these, alternatives have demonstrated way less to no correlation with stocks and bonds. I'm talking about long-short equity funds, market-neutral funds, commodities, managed futures funds. If you're unfamiliar with these, I'd recommend learning about them. That's why they're the main focus of my mini book, Stop Investing Like They Tell You. I'll put a link in the description to where you can get a copy. It won't be in stores until mid-October, but I can send you a copy if you're interested. Just check the link in the description. Again, I could create a few videos around each of these underlying asset categories, and if enough of you are interested, I will. But I just want you to know that additional asset classes offering a statistically superior diversification exist and are worth your time to learn about. Now, I am a registered investment advisor. I actually manage people's money, and I know that a lot of people aren't interested in learning all the details themselves. So if that sounds like you, I'd love to help. Just go to investinyourfuture.com. I'll put the link in the description. And I hope you'll forgive me for plugging myself several times in this video.
Please forgive me, brother.
Please. But you have to remember, answering this question is my origin story. Virtually everything I've created exists to help people better protect themselves in volatile markets. Strategy number 4, diversify again. Now, I talk almost exclusively about stock investments, but when I say that I want to help you build your highly diversified net worth, I'm talking about even diversifying beyond those paper assets we just talked about. And that's why I brought you here, to show you some of the other areas in which I invest so that on the whole, I'm better protected. During the Great Recession, residential real estate prices fell alongside everything else, but that was a statistical anomaly. Usually they're pretty uncorrelated. In 14 of the 15 previous US equity bear markets, going back to 1956, home prices rose. And in that lone bear market prior to 2007, in which home prices did fall, they did so by just 0.4%. So owning residential real estate can not only provide you with rental income, like a dividend-paying stock, during a market crash, but it would also likely insulate you from capital depreciation. On top of that, I personally like the control I have over my real estate portfolio. With a stock, I have to worry about management and the board and a number of other factors. With real estate, I'm the one making the decisions. I bought my first rental in 2008, and now we're up to almost 15 units. Cool. Cool. I tell you this to demonstrate that despite my clear obsession with, and despite spending 90% of my work time researching or talking about stocks, as you can probably tell if you're subscribed to this channel, despite all that, I still recognize the importance and value of carefully diversifying into other areas. For me, this gives me peace of mind. Not only am I well diversified within my paper investment portfolio, but I'm also highly diversified in other areas as well. This offers me even greater protection and flexibility without sacrificing growth, no matter what happens in the stock market. All right, now Phil and I are gonna go check out Wall Street. Now, I have experience in both these areas, real estate and business, but the reason this channel's focus is stock investments is because that is where I have a unique level of expertise and understanding that I felt wasn't otherwise available for the average investor. And I'm sure on occasion in the future, I'll share real estate and business anecdotes and lessons that I think you'll find valuable, but I don't want to position myself as that expert for you. There are already some amazing resources out there. I recommend you check out Kevin from Meet Kevin. He's a great real estate resource. What do you say, Kevin? Are you willing to help out?
Oh, what's up, Steven Spicer? Whatever you need, send them my way.
Awesome. Thanks, Kevin. I really appreciate that.
Whoa, wait a second, man. What about my channel? We got to talk. What about my channel? I talk about real estate too. People got to subscribe. And they got to make sure to smash the like button on my channel. Make sure to mention my channel.
Of course, Graham Stephan. Yeah, thank you so much for your willingness to help out. If you are at all interested in real estate or just curious about the prospect, you have to check out their channels. I'll link to both of them below. Kevin and Graham are my go-to real estate resources here on YouTube. Both top-notch real estate experts and just all-around good guys. Check them out. And for business and or passive income, Pat Flynn is my go-to. You won't find a better, more experienced resource in the world of passive income. What about you, Pat? You willing to help out?
Hey, what's up? Of course, I'd love to help you grow. You're in the right place. I teach people how to take what they know and turn that into a business. Thank you so much, and I appreciate you.
That's the best I could get. Pat's a busy man, but a valuable resource nonetheless. Check the description for links to his channel, his podcast, and his website. The point with all of this is figure out which of these you're most interested in. Real estate, stocks, business. Start there. Learn as much as you can, and once you feel comfortable with your strategy, start working on the next one. You don't have to limit yourself. Oh no, it's Wall Avenue. I always thought this was Wall Street. Total rebuild.
That's a metaphor.
Strategy number 5 is options. One of the most common practical responses to the how do I protect my portfolio question is to buy put options on a market index. And if you don't know what all that means, 1, don't do it. 2, if that's something you'd like me to dive into more, again, broken record here, but just let me know in the comments. But for the sake of time, I'm just gonna proceed as though you have a rough idea of what all that meant. Now, this is a strategy used by a lot of hedge fund managers. You'll often see S&P 500 puts as one of their largest positions when markets seem overvalued like they do right now. So it's clearly worth exploring. But what isn't said, and this is something that I think you should be aware of before implementing a strategy like this, is that equity puts are expensive. Cole Moshe, in his interview with Jack Schwager in Hedge Fund Market Wizards, explains, one problem with buying equity puts is that equity volatility tends to be very expensive. Who's the natural seller of equity puts? No one. Who's the natural buyer of equity puts? Everyone. The world is long equities and people like owning insurance, so there is an excess of natural buyers for equity puts. That is the reason why equity option prices are structurally expensive. So if you want to pursue this strategy and you're willing to pay the premium for this sort of direct insurance for your equity portfolio, by all means, buy some S&P 500 puts, but you need to recognize beforehand that they will eat into the rest of your portfolio's returns each year that you don't end up needing them. For that strategy to ultimately pay off, you have to understand that and be willing to suffer through. The same is true for those hedge fund managers I just referenced. Many of them have had their puts for years already. But just because you don't end up needing them in a given year and you just wasted that money that you spent on their premiums, that doesn't mean it was the wrong strategy. That's like being mad at the flood insurance salesman after a year of paying for the insurance and your house being flood free. That's not how it works. That doesn't make any sense. And one final way you might want to consider using options is to play the upside. It seems like the hardest part of recognizing that the market is overvalued is knowing that everyone around you is profiting, at least temporarily, from the euphoria. That can be painful. That euphoria can go on for years, pushing markets or individual stocks to highs never before believed possible. Well, instead of biting your tongue and remaining disciplined as long as possible on the sidelines, what if you just played the upside using call options? So you think Netflix is overvalued, but it just won't stop climbing to new heights, and you're tired of missing out on all the gains. Well, if you buy the stock, you risk being stuck if it comes crashing down tomorrow and liquidity dries up. Not even stop orders would save you there.
What happened? You said the thing was supposed to work.
But if you buy a Netflix call option, you still have the upside potential, but now your downside is limited to that premium you paid. So there you have a couple ways that you can use options to better position yourself despite the unpredictability of the market. So maybe the right thing to do in a situation like this doesn't have to be sitting on the sidelines with your bags of cash while everyone else waves their massive gains in your face. And maybe it doesn't have to be entirely exposing yourself to potential chaos. There is a better way where you can better protect your portfolio without sacrificing gains. And it doesn't have to be complicated. Start simple and work your way up. Increase your allocation to dividend stocks. Learn to always invest with a margin of safety. Diversify beyond just stocks and bonds. Diversify beyond just paper assets. And understand strategic put and call option strategies. There is so much here and so much more to cover. I'm excited to hear from you which areas you would like to explore in greater detail. Thank you so much for sticking around. I really do appreciate all your feedback and support. And if you enjoyed this video and found it helpful, don't forget to let me know with a like and share it. And if you're new here and haven't already, subscribe, click the bell, and let's start building and strengthening your rapidly growing, highly diversified net worth. I'll see you in the next video. Take care. Are you smiling?
You want to do that again?